JP Morgan had sounded out the bugle of warning on Indian IT services for some time now, both on IT services and the ERD companies. Q1 seems to be panning out more or less as they thought, because their report, even on the 3rd of July, stated that there is no summer for Indian techs, as June likely to be the weakest in a decade. Now, whether or not it's turned out exactly that way, you can argue, but those are, that's water under the bridge. More importantly, the commentary as well as the numbers that have come in from large IT majors thus far haven't been as great. The question to Ankur though is this now uh, getting priced in, and what is it that he's looking forward to over the course of the next 4 to 6 quarters when it comes to IT services? He's the head of APAC Telecoms and India TMT Research. Joins us right now on the show. Ankur, great having you. Thanks for taking the time out.
Hi, Neeraj. Thank you for having us.
The pleasure is ours. So, Ankur, what did you what had you anticipated when you wrote this note about IT services? I'm talking about services right now being the weakest in a decade. And what have you made of the numbers that have come out thus far?
Yeah, so Neeraj, when we wrote our report about, in the recent research, we've been highlighting that the relative demand environment for IT services has been, remains weak, and the enterprise spending sentiment has been weak. This is what we've been, hearing from conversations across the value chain for a while. And we were expecting that companies will see not only a weak performance in the June quarter, but the likelihood of any kind of recovery in technology services spending, enterprise spending on technology in general, especially for IT services, will not have any clear, visible recovery, timeline or horizon. I think that's sort of what is all sort of beginning to play out. So I think incrementally, F24 is what we were expecting to be, a bit of a washout. We were expecting growth to be less than 5%. It's largely seems to be in line. Companies that have reported, which also guide among the bigger companies, seem to indicate that's what they sort of beginning to see as well. I think the incremental conversation now should be, I think, two or three areas. One, where is the potential for growth in the medium term for these companies? Is this part of a long term, mean reversion, and hence growth sort of goes back to pre-COVID days, which was sort of mid to slightly high single digits? What is the right valuation for these companies, which maybe in the medium to long term only grow 6 to 8%? Given the valuations right now are above pre-COVID levels, even though the growth is sort of at back at sort of pre-COVID levels, maybe cyclically weaker this year. I think the second big conversation to have is what's the likelihood of structural potential headwinds for the industry? Things like generative AI, could that be deflationary? Could that be inflationary? How can that impact these companies, and how should people think about that from an impact out on the industry?
Okay. Um, I, I'm not asking you to comment on specific companies. You can use them as illustrative examples, Ankur. But I'm just trying to understand that when I look at what Infosys, for example, said, right, and which caused the real flutter, I thought. I mean, commentary seems to be negative on existing demand, on client decisions, on current execution of mega orders as well, and on the availability of mega orders over the course of the next few months. Now, could this be different and materially different for different companies, or could it be more in the same vein, just that when it is hitting different companies might be different? Part one of my question is that. And could there be companies, or could there be segments which could be materially insulated from something like this, in that maybe BFS is very, very impacted, and therefore some companies are sounding out slightly different than maybe some of the others?
Yeah, I think look, we almost have every large company reporting so far. Almost all the industry and sector bellwethers have reported, and I think what's sort of common is three or four factors. One, almost everybody has seen a significant impact of referrals of existing projects, especially discretionary projects. Everybody's seeing unexpected ramp downs across a range of projects. A lot of people have seen delays in new project starts. A lot of people have seen customers just sitting on any kind of approvals going forward. So there was an expectation back in the March quarter, or at the end of the March quarter, between April and June, that some very large deals will be signed. Now we have seen in the quarter, some large deal signings reported by companies. However, there's been two sort of complications there. One, I think a lot of the large deal signings perhaps are renewals, and two, they are potentially been in the works for a while. But a lot of incremental large deal signings, even if they are signed, the visibility on when they will actually start, there's a lot of uncertainty around that. I think what a lot of large enterprises are reacting to is just the macroeconomic variability, whether it's interest rates or inflation or just potential for changes in the way they think about their spending momentum. That is sort of not translating to revenue conversion. I think that's a very common trend across almost every company that's reported so far, and we don't think that will change. From an industry perspective, you're right. Banking, financial services has seen the significant amount of impact, and I think that will stay. Given it is about 30-40% of industry revenues, the impact is exaggerated. The second industry which continues to see an impact is TMT. Within TMT, there is telecoms, which continue to be impacted. There is media, big tech, which continues to be impacted. Parts of high tech perhaps are recovering, but again, TMT as a whole is kind of weak. And this is again 15, between 10 to 20% of everyone's revenues. The third big, not industry, but the sort of commonality is, this is a lot more visible in North America. But we also see from company conversations that the North American uncertainty, which was definitely there in June, is beginning to spread to Europe, which is also concerning because North America and Europe is basically 80% plus of the industry's revenues. So yeah, I don't think there will be any clear exceptions. There might be small companies which might avoid this for a while because they're much more client specific.
Got it. Ankur, interesting that you say that. Just a follow up there. The belief was that led by 5G spends and modernization out of TMT, Telecom at least, will actually see a bump up. That was an anticipation maybe 6 months ago at some quarters. It's not quite playing out that way.
Yes, I think you're right. 5G was expected to be a driver of incremental growth, both in terms of what telecom companies might invest, in terms of rewriting their application architecture, rewriting their networks, but also from a broader perspective, what enterprises might invest in it as a result of 5G investments. Now, I think on the first part, on the telecom side, we've seen a lot of telecom firms globally across different regions. Asia Pacific companies began to invest in this maybe 3 years ago. They were early. The US began to invest about 2 years ago. Europe has been investments to an extent. But I think what's been visible this year is a lot of global telecoms have woken up to the fact that monetization is really tough in 5G. Consumers just do not want to pay. And enterprise use cases are sometime away from at the moment. So I think telecom firms' investments in 5G are beginning to sort of turn south. I think that's not leading to any kind of significant visible 5G related spending. So maybe this is somewhat we're probably behind the peak there. On the enterprise side, I think it's sort of early. We have seen some of it impacting industries, especially manufacturing and industrial to an extent, but I don't think it's that significant, at least just now. So it's not something which is here and now, which is impacting from a theme perspective as much as one had hoped for.
Got it. Now, the other question is, when I hear some of the mid-sized firms, particularly on the ER&D side, right? Again, I'm using these as examples, illustrative, not asking you to comment, but LTTS flat growth, but says we'll still meet the organic growth guidance, constructive on the next 3 quarters. Persistent, not as strong a growth as it was 12 months ago, but saying that under the environment, we'll still continue to grow the way we have, and that may be good. I read your report about one company, probably an exception to the rule of low growth, by posting high growth. Though you guys are negative on that company's stock price performance any which ways. How do you look at that bucket?
Yeah, I think ER&D as a subsector is interesting because number one, the exposure to banking is a lot lower, right? Banking is a lot lower, and hence they're not growing as as slowly. Number two, the penetration is lower than IT services in general, and hence the growth rate is higher. Number three, parts of ER&D, especially the auto sector, I think that the growth there, the imperative for growth is quite significant, and hence we've not seen an impact on discretionary spending cuts to the same extent. So auto seems to be sort of immune, to answer your earlier question as well. And companies which are exposed to the auto sector, I think, are relatively safer. Now, I think in other words, in other segments of ER&D, we are seeing, for example, parts of TMT, parts of medical devices, parts of manufacturing outside of auto. There is an element of softness that is beginning to creep in. I think our conversations with people in the R&D supply chain, engineering research and development services supply chain suggests that even their discretionary projects are getting impacted. If the ROI is not soon enough, it is considered discretionary and it can be cut. So we are definitely seeing, growth softening a bit. Auto is the only sector which is to an extent standing out. So given that, we will also see the growth slow down. But of course, given these companies are growing from a much lower base, their parts of exposure to BFSI is lower, the absolute growth momentum we would expect will be much higher than IT services firms, probably even some of the mid-cap IT firms. But definitely softer than the market expects. And I think from a valuation perspective, these companies already enjoy what we think are very, very very, very optimistic valuations, and hence don't leave anything on the table, which is why we are a lot more underweight even on the ERS names.
So, what are the markers that might turn? So, I'll tell you the bullish argument that I heard from somebody, Ankur, and an argument was that incrementally, और कितना bad news आएगा? The new budgets come only in January. So incrementally from July to December, if clients want to put in money into India because a lot of other geographies aren't quite that investable, then aside of banking, a large sector that is available, which is pricing in some of the headwinds, is information technology without any material negative news flow, which is not already discounted. What is your reckoning on that?
Sure. So look, we are fundamental analysts, so we'll always look at fundamentals first and market flows later. From a fundamental perspective, we don't see any clear signs of a demand recovery. While some of these stocks have not done very badly, we acknowledge the fact that IT services, in the last 1.5 months has enjoyed a bit of a rally on the back of macro factors. But just look at the fundamentals, right? Enterprise technology spending sentiment is not recovered. The parts of the supply chain that we look at, IT services are somewhat late cyclical, but even the early cycle plays, whether it's enterprise hardware or enterprise software or SaaS or cloud, any of them have not really seen any kind of growth recovery. Even parts of enterprise software and cloud are still seeing negative surprises. So we think any kind of genuine upturn on spending and demand is yet to be visible. Until that doesn't happen, I think that will be one of the true markers of success. And of course, the flows into these things can behave differently temporarily, but eventually fundamentals is what counts, and that will probably hold up against these names if growth doesn't come through in terms of what's priced in right now.
Sorry, maybe I didn't explain my question properly. What I meant was, do you expect that there could be incremental negative news flow in this space, or is the news flow, the negativity or the pessimism of the news flow is now discounted? What the impact on price is secondary, but is the news flow now kind of well known, or could there be incremental negatives?
Sure. I think after this result season, the sector has probably been grounded a lot more in reality from a growth for F24 perspective. I think that's probably been brought down to drawn to earth, where we still see some signs of optimism, which probably still will get faded out over the next 3 to 4 quarters. One is margins. I think there's still an expectation and hope that margins might hold up even if growth doesn't come. So I think that probably gets faded out over the next few quarters. But more importantly, if we sort of look forward going into F25, 26, we still find the expectations of growth seeming very, very optimistic. I mean, average expectations of growth, even in large cap tech, is mid to high double digits and sort of almost teens. We think that's extremely optimistic. We think long-term growth momentum is high single digits. So I think that is something which can drive negative growth momentum if there are negative cycles around, for example, US election cycle impacting uncertainty into F25. I think growth expectations for F24 can come down. So that is still a negative point which can come through. So margins is one for F24, growth for F25 is another. And the deflationary impact of trends like generative AI is still not factored in, which can come through over the next, which could significantly impact the narrative. So I don't think there's dearth of bad news that can come through. And the expectation that the growth is bottomed out for F24 is fair, but I think a lot more can still sort of negatively surprise.
So suffice to say, Ankur, before we wrap up, that in the near to the medium term, you, as of now, as things stand, don't foresee any positivity in terms of either news flow or in terms of valuations having bottomed out. I mean, unless the stock prices move further south across the spectrum. I mean, it would take something, whether a significant stock price correction or news flow materially changing on the global economic front for you to change your outlook towards these companies.
I think what we'll honestly look for, and I think what investors should look for genuinely improvement in these stock prices on a multi-year basis, especially for long-term investors, is one, valuation sort of becoming a lot more reasonable. Like I said, growth is lower than pre-COVID levels, but valuations are a lot higher. So those valuations becoming more palatable. Number two, a genuine improvement in the demand environment. We haven't really seen even early signs of that. So I think early signs of that improving, like I said, the technology supply chain improvement. And number three, if there's any sort of clear macro improvement, we've seen a few inflation prints in the US coming below expectation, but there's no clear signs that the earnings recession in the US is behind us. That's what's impacting these companies.
Got it. Ankur, this was a pleasure because it's such an important sector that good to get your view. You were amongst the early ones in kind of projecting your outlook, a negative outlook, if you will, if I can use that term, towards this space. It's kind of turning out that way. Hopefully, it gives you a chance to turn your outlook sooner rather than later. But thank you for taking the time out and being with us today.
Thank you for having us. Thank you.
Now, the pleasure was ours, viewers. Thanks for tuning in.